Well, KCB has released half-year numbers for the period ending June 2022, and we're delighted to have, for the first time, the new man in charge, Mr. Paul Russo. Delighted to have you on set.
Thank you, Julian. Great to be here.
Paul, I've had recurrent conversations with executives from KCB, and my view is that KCB is struggling with asset quality, especially the Kenya division. If you look at it, at about 22%, it's flying significantly above the industry average. Why is that the case?
So let me try and delve on the latest of the numbers. I think Q1 we must have been at around 17 or thereabout. Two things do happen. One is you're on the back of the post-COVID, restructure and hosting. And the second one is, and typical, and I hope I find the right words for this. You've got a new CEO that comes in and looks and says, what is the right direction to take on those numbers? So from an IFRS perspective, we've had the right classification of those facilities, but some of the names that were on moratoriums and restructure from COVID time, needed to be a different view. And I would personally look at it and say, if you take over, you have to take a long-term view. So that's what has caused the tick-up, and I've actually been saying that to the investors. The good news is, and the other point is, at the end of the day, because you are the largest bank, particularly on the corporate side, you're likely to have, legacy kind of names, and you have to make that call. The good thing is, you take that view, but you put in your recovery plans, not recovery in terms of not just to bring that down, but to turn around those businesses. And I want to, you said you've spoken to a number of executives. I just want to tell you it's already looking down from that number of June. And that's because we'll do what I said when I was speaking about answering questions. It's about execution, it's about action, it's about orientation, about that resolution. So not the best today, but that's actually the highest.
And allow me just a quick follow-up on that then. If I understand you right, is that you have had a bit of reclassification of your loan book. I'm just curious to understand what proportion would you say has been cascaded from stage 2 to stage 3?
So I think it's actually 9 names across the group, if I remember it correctly. It's around 9 names across the group. Maybe 8 KCB Kenya, 1 is an NBK name. Now, and that's why it's easier then to start tackling it down and bringing in that discipline of managing it. And I think, Julian, you need to look at it. We took NBK at 52, so at 33. So we certainly know what it takes to look at fixing those names.
The group has today given guidance in terms of where it wants its asset quality to stand. And it's not the first time we're getting guidance on asset quality from KCB. Are you worried that you could get to a point where the market overlooks the guidance that the bank gives?
No, because I'm not going to speak on any other past commitments. I'm going to be held to account of the commitment that I made today. That number of 15 to 17 at the end of the year is actually a number that I buy in and would want to breach that number lower. But again, you're staring at a specific period. So I'm not going to refer to past commitments. I'm going to refer on my commitments about what we are doing to get to that number. And as I say, in the last 3 months, actually tomorrow is my 90th day in the job. it's come down. And therefore I'm bullish about what we've committed. So the 15 to 17 is actually a commitment that I've made to the board and I'm making to the markets.
I'm still intrigued by what we have seen in terms of NPL ratio and the fact that KCB scaled down on provisions, especially when you consider there was a reclassification that happened here. Don't you see a misalignment there?
No, and I think that, and I think, Lawrence did explain, there was the right classification from an IFRS perspective, which is what you use for your reporting and accounting. I think what you'd have seen is a reclassification from a CBK point or a reporting point of view from a regulator perspective and therefore from an NPL perspective. Maybe the question that is the room is, why didn't you reclassify the rest as it should have been? And I think, like I said, you got into COVID, you took position on certain names. There was discussion of giving, a breathing space for certain names, but you get to a point and you say, CPK did actually revert back to the other positions and you make the right course.
NBK, from my assessment, still looks like it's skating on thin ice as far as capital adequacy is concerned. There have been efforts, not once, to recapitalize NBK. How much are you injecting in the at least immediate term in view of the situation we've seen in the numbers?
I think because it's on total capital that it's in breach at the moment, it would have to be a tier 2 injection. I would have to be from a debt perspective. I think let me take a step back. So the number of things we've not done in right sizing and correcting NBK in the way we wanted to do. And I don't know whether I've explained this to you in the past. One is bringing NBK into the same core banking system with KCB gives you opportunity to leverage on quite a number of things to be able to deliver. So NBK has been on Finastra, KCB is on T24 core banking system. But there were existing contracts that you needed to run down to be able to just do the right thing in terms of cost containment. So that is coming to an end, and NBK will move to T24. That gives us a lot of opportunities because it gives us opportunity to deliver shared services model for the entity. But it also gives us the opportunity to redirect the strategy for NBK. So without saying a lot, there is a plan, and that plan is understood by the teams. I think at the end of the day, we have to always ask ourselves, do you run 2 branches in the same locations, for example? Now, if you are in the same core banking system, it actually helps you to share outlets. There lies the synergies that we really want to look for. So being able to service different entity customers through the same outlet. And also just tackling some of the difficult names because there's a lot of capital that is held in there. I have because I was there until recently. I've got to crack and say, what do I do with 10,000 acres in Lamu? Because there's a lot of capital that is tied up in there. So there are a number of strategies that we're working around it. But I see NBK in the end being a corporate and SME entity. That there is space for it. We see it in the numbers, and it does help us in leveraging opportunity to service different clients.
If you see NBK being a corporate and SME led bank, for those of us who are accustomed to looking at NBK as a bank which deals with a lot of government franchise, where will that business be going?
That's in the corporate world. So corporate largely will be public sector driven for NBK. And if it delivers the value propositions that they've been working on, and I know that, in some instances they are ahead of KCB Kenya in certain proposition, then we've got that opportunity. I think what you want to do is leverage on the competencies of the two organizations, but also just don't drive business as usual on the model, on the size, and then ignore getting value out of the group shared services.
I want to spend a little bit of time talking about DRC. First, how do you justify the pricing to shareholders? And I'm coming from the context that I was working back the last 2 or so years. If you look at the price to book multiple for acquisitions, it is slightly above 1.0x. Whether it's Access, Transnational, I&M, Oriental. KCB is coming here with 1.49.
So I think, as the group chairman did put out, you've got those entities are different, Julian, and you've got to. So you come with your cow and I come with my goat, and the prices will be different. Different methodologies that have been used around it, but also what you are likely to be able to get out of it. We've considered, or the board. By the way, it is still subject to shareholder approval. Let me first be very clear around that. The board has considered what we think we can deliver through TMB and in partnerships with the parties that are on TMB today. And we believe we'll commercialize and get value out of it. Time will tell. Hopefully I'll be judged when I'm in this role about commercializing that.
Okay. I was combing through the latest filings by TMB, and it looks to me like the bank is having a struggle with efficiency. Because from a cost to income standpoint, I think the last number I saw was at about 76%. What would be your immediate action to address that?
So let's first look at a number. Because it's a very, you just know the size of the country, and if you have 110 branches, right? The first point for us is, put it under, as I said, put it under T24, same core banking system, pick that up, and it's definitely being run through Kenya. Get economies of scales from a technology perspective, but also drive digitization. It's an expansive country, but also I think if you look at competitors, you create avenues to truly commercialize the capabilities. Given where they are today, even with what they have, they're limited to just placing funds in other banks, including banks in Kenya. We think we can have ways of commercializing a lot better. There's a fast mover advantage. There's also lessons you learn from what has happened. But I see technology as being the key driver. We have to use what I said earlier on, a hub and spoke model to be able to deliver on that. But also KCB knows how to run efficient entities. I think we've come from the highest of what cost to income ratio ourselves. So it's I think when we took NBK it was 95, down to around 60. So Julian, hopefully God keeps us, then we run an interview again downstream. We think we do have our strategies to commercialize.
Okay. Another thing which stood out for me in the TMB numbers is that they have a relatively outsized pie of NFI as a proportion of total income. Because when I was looking at it, I think it was at about 83%. Are you comfortable with this? How would you intend to skew this now under KCB? Should it receive all the approvals?
Yeah, so they've not deliberately been into the lending side of things. I think, yeah, without going back to, and I'm trying to be as measured as I can be for because it's pending approvals. Is in there lies the other opportunity, right? Um, so when I talk about technology, um, today they're manual. If on credit, we can take our competencies, our technology on credit. We've got capabilities to assess bigger tickets across the place. We can assess risk correctly. So again, without taking you back to the same number, those are exact reasons why we think there are opportunities.
And Paul, I must tell you, in a previous life, I did cover the banking sector in DRC. And one of the things which that market struggles with is risk profiling. What's KCB's plan around this?
So it is. It's like South Sudan, right? Exactly. In many ways. It's one of the actions that we really have to put in place. You believe that you've got the right level of governance, the right level of risk, whether policies, processes, AML monitoring capabilities that we have across the group. You would have to deploy that. But remember, again, at the end of the day, in as much as you're in DRC, you're supervised by the regulator in Kenya. So the standards don't change. But how do we navigate? I think, Julian, we must also say, now that they're in East Africa, we could be the better brothers in practice, but we should be the parties that then go and introduce and embed standards. So I see, those that have gone before, and as we go in, as helping to strengthen, the standards. So, for lack of a better word, let's go in and help and bring, because who else is going to then bring those levels of standards?
A number of banks in DRC are headquartered in Kinshasa. Here we have TMB in Lubumbashi, a mineral-rich region. How much was that a factor in the play?
I think the distribution network, let me say, was a factor in play. Was one of the factors in play. I think just even the corridors of border with Rwanda and that presence and ability to commercialize that, it was a factor in play. But we also have customers today of KCB that operate in DRC. And I can tell you there is a big customer that actually, coincidentally, when we announced, just sent me, said, my friend, here is evidence that I'm actually banking with you. I said, with who? And it's TMB. I think we do see opportunities, even as the whole process on mining is formalized. There are country risks around that, but a long way to tell you, it was a factor, and the presence of TMB in Lubumbashi is big.
Sure. All right. Let's talk about the dividend for a while. Why I'm asking that is because should this deal, the acquisition in DRC, be consummated, I'd imagine there would
be some capital outlay necessitated by that. To what extent would that then have an impact on your dividend payouts?
I think the decision why we always make our call, and in the last, because I've been in the organization in the last few years, a Q3 decision, is because we have clarity about the whole funding mechanisms for the entity. Will it play in the minds of of everybody that makes the decision, absolutely yes. But I think there's been sufficient earlier process to work out the funding for the transaction. So it isn't something we've woken up. I think, Julian, we've been on DRC for a while. I think people see when you announce. People critique you when you have not gone in and somebody else has gone in. But we've been on DRC for a while. And therefore, we've got a plan on funding.
When the DRC announcement was made, Paul, unlike a similar announcement which was made about a year earlier, or a year or a little more earlier, the share price movement on KCB was muted. And my question to you is, how do you respond to those who say that perhaps the crown jewel in DRC had already gone, in terms of the banking space?
The best way to respond to those parties is to deliver results out of it, right? I can argue here anything else. Maybe at a personal level is to demonstrate more as a fighter to bring that to the table. I think, Julian, you will always come across naysayers. But the best way to answer naysayer is to get out and do something meaningful, right? You can, as they say, you can stop and throw stones around every barking dog, or you can decide to take your journey and get to where you want to be. So it's fair for anyone to doubt. Remember, we've come in, made this announcement, within a context. There is a global geopolitical item. There was transition in KCB in itself. There'll be things playing around. As you said, this is not the first time you asked about NPL and so forth. The NBK one will always play in the minds of people like yourself. But I always say, why don't you look at the success in BPR? Right, Julian? And let God give us long life so that we can have the convo. I think I want to, if we get the approvals, the only way to answer is in the performance. I have demonstrated that in BPR, and I was leading the project.
The conversation around risk pricing, it's something we've touched on before. We've kept on discussing about this. What's just the latest?
So I think maybe I give, in my own words, the context. Every entity runs their modeling, gives out a proposal, then there's a back and forth in terms of how you develop. I think from where I sit, we've concluded the engagement with the regulator. I think we have an alignment. That's not the issue. I think in the past we probably spoke about it when the process was ongoing. So I can comfortably say is that we've responded, and I think we have an alignment with the regulator, and they should be concluding that process. If you were to ask me, I should anytime now. Because I think, I always say, different from most people, the regulator is not some animal out there. I think we engage on a daily basis. So should be concluded. I think what I'm asking my team now is how to implement. That's actually what we should be thinking about rather than the approval.
The dichotomy of the numbers you gave around Fuliza versus Vuma. Not too far back, KCB had decelerated on the mobile lending. That differentiation between the two, is it an indication that we are now chasing less on volumes, more on margins?
I think let me say, it's not leaving anything on the table, right? But always also understand that we're in business. But Julian, you know that we made investments in tech a long time to be able to deliver the Vuma proposition. I've used this term for a while, but it's about getting return on investments on those deployments. So it's commercialization and getting that through. I believe personally that we have got opportunities for lots of partnerships. I am a firm believer of partnerships, not competition. So we're just starting to get the results of what we should have got, and maybe I'm just there to report, what had started earlier.
KCB has been overweight, at least in my view, on real estate lending. Do you intend to change this now that you're steering the ship?
I think we must fund, facilities based on cash flows, right? You've got to see, you bet on what is the outlook, what are the numbers, what are the cash flows that come through, Julian. Just like any credit. So I wouldn't say we'll reduce on any sector, but there are sectors that will have to be looked at keenly. And it will have to be a project by project. And I think we've got governance. We've got a management credit committee that we put in place that actually looks at those facilities even before they go to the credit committee. They've got their own limits for approvals. They are fully empowered. Their mandate is clear. So for me, it's just making sure that process does work. I think the many times, it helps that I'm not a banker in many ways, is do you lend based on securities or do you lend based on cash flows projections? Yeah? And I bet you have the answer.
So now that you've mentioned that, Paul, a question which stood up to me when actually I saw your name as the next CEO, it was you don't have a strictly banking background per se. How do you view that? An asset, a liability? How does it play out?
I've been in banking for 17 years, my friend. Maybe it's just that my name doesn't reflect in other areas. So let's stay away from banking, and I kind of like using examples. I said the first thing you need to ask yourself if you want to run a business is whether, Julian, you can run a kiosk, your own kiosk. Right? Whether you'll be able to decide what is your Yoda level for milk, which will expire. Right? And how do you deal with bread when it's only 2 days that are there? You stock bananas in a kiosk, you stock tomatoes. How are you going to make sure that you recover your money? If you can run your kiosk, then you can start having the license to talk about other people's money. So at the end of the day, it is the commercial acumen. But also, it's about your leadership to deal with lead subject matter experts. And no CEO today can claim you can be a finance expert. You're not a subject matter expert in IT. You're leading IT, right? But those are our people. I'm a subject matter expert on people. So, and I've led teams. I don't need to justify it to anyone. There's a process, come through, and you've got a whole profession to defend so that people don't judge HR people downstream in the wrong way. So I think leadership today, just as you had you bring different competencies together to deliver strategy. Right? So how do you assemble those competencies to deliver your strategy? And that's my job. Right? Over and above that, and I said earlier on, for KCB is to inject a sense of urgency. And I think I know how to do that a lot. So, and I'm not underrating you'll have a competent CFO, you'll have a competent chief technology officer, you have competent retail director, corporate director. How do you bring those competencies together? That's my job.
Paul Russo, I wish we had more time.
Asante sana. Thank you. Thank you. Thank you. Thank you.